Have you ever, I don't know, thought about what a guy like Warren Buffett does with all his money? What's he actually doing with it?
Yeah, it's super fascinating, right? Especially when you compare what those investing giants are doing with what some of the top analysts on Wall Street are predicting about the market.
Right, and that's exactly what we're going to do today. We're going to do a deep dive into this really interesting situation where you've got Warren Buffett, the Oracle of Omaha, selling off some of his stock, and at the same time, you've got this analyst saying the market's going to go way up.
Yeah, it's a bit of a head scratcher at first glance. Definitely some contrasting viewpoints to unpack.
It is. Okay, so specifically, what we're looking at here is Warren Buffett's company, Berkshire Hathaway. They sold all of their shares in the Vanguard S&P 500 ETF. That's VOO for those of you following along at home.
Which is kind of a big deal because, Buffett has always been a huge advocate for index funds, especially for the average investor.
Exactly. I mean, he's been saying it for years, literally, that the S&P 500 index fund is the best way for most people to invest.
Right. The article even quotes him from Berkshire's annual meeting a couple years ago, back in 2021, where he said, quote, "I recommend the S&P 500 index fund and have for a long, long time to people."
So when news came out that he was selling all his shares, a lot of people, I think, were like, hold on, what's going on here? Does this mean Buffett's not so bullish on the market anymore? Has he lost faith in the U.S. economy?
I can see why people might jump to that conclusion. When someone like Buffett makes a move, people pay attention.
Yeah, for sure. I mean, if he's selling, should we be selling? That's what a lot of people are probably thinking.
Probably. But the article we're looking at today from The Motley Fool, it does offer some additional context that I think helps paint a more complete picture.
Okay, good. What does it say?
Well, for one, it mentions that Buffett recently said in an interview, I think it was with CBS, that the majority of the money he manages will always be invested in the United States.
So that doesn't sound like someone who's completely given up on the U.S. market.
No, not at all. So if it's not because he's bearish on America, then why would he sell all those S&P 500 shares?
Right. What's the deal?
Well, the article kind of suggests that it comes down to Berkshire Hathaway's very specific investment strategy, which, by the way, is laid out pretty clearly in Buffett's 2010 letter to shareholders. He said, and I quote, "Our job is to increase per share intrinsic value at a rate greater than the increase, including dividends, of the S&P 500.
So their goal is to do better than the S&P 500, not just match it.
Exactly. And owning an index fund that just tracks the S&P 500, well, that's not going to get you there.
I see. So it's not that he thinks the S&P 500 is a bad investment?
Right. He's just got different goals.
It's like, I don't know, it's like comparing, someone who's just trying to, stay in shape versus a professional athlete training for the Olympics. They're both focused on fitness, but their goals and training methods are going to look very different.
Yeah, that's a good analogy. And I think the key takeaway here for our listeners is that just because Warren Buffett decided to sell some shares in a S&P 500 index fund, it doesn't mean you should automatically do the same. It really comes down to your own personal investment goals.
Right. Everyone's situation is different. But, speaking of different perspectives, we've also got this analyst. What was his name again?
Tom Lee, yeah, he's with Fundstrat Global Advisors.
Right, Tom Lee.
Yeah.
And he's got a very different view of what might happen with the S&P 500, right?
Definitely. He is actually quite bullish on the market's prospects.
Bullish, yeah, that's one way to put it. He's actually predicting that the S&P 500 could reach 15,000 by 2030.
Which is, to give you an idea of scale here, the article mentions that the S&P was trading around 5,768 when it was written. So Lee's talking about a potential gain of something like 160%.
Wow. That's huge. So what's he basing that on? What does he think is going to drive that kind of growth?
Well, he's got a couple of key catalysts in mind. First, he points to the millennial generation. It's the largest generation alive right now, and they're starting to hit their peak earning years.
And we all know what that means, right? More spending power, which usually translates to economic growth.
Yeah, exactly.
Yeah.
More money flowing through the economy, more businesses thriving, more profits, more, stock market growth.
Makes sense. Okay. So what's the other catalyst he's looking at?
The other big one is he's forecasting a pretty significant global labor shortage by 2030.
Oh, right. I remember reading about that. I think it was something like 80 million workers, right?
Yeah, something like that. It's a huge number. And Lee's thinking is that this shortage is going to create a massive demand for artificial intelligence AI to automate a lot of the tasks that those missing workers would have been doing.
So he's seeing this potential labor crisis as actually a good thing for the stock market, at least in the long run.
Yeah, because the companies developing and implementing AI solutions are likely to see, a surge in demand for their products and services. And remember, the tech sector is a huge part of the S&P 500.
Right, like almost a third of the entire index, I think the article said. So any significant growth in that sector could really push the whole market higher.
And to support his argument, Lee actually draws some parallels to past periods in history.
Oh, really?
Yeah, he points to two specific periods, one between 1948 and 1967, and another between 1991 and 1999. He says that both of those times saw, similar global labor shortages and also, coincidentally, a big boom in tech stocks.
So you're saying, look, this has happened before, and when it did, the stock market went crazy.
Pretty much.
Okay, so I think we've laid out both sides of the coin here. On one hand, you've got Warren Buffett selling his S&P 500 index funds. On the other hand, you've got this analyst predicting massive growth for the S&P 500. It's a little confusing, right?
Yeah, it definitely seems counterintuitive on the surface. But I think it's important for our listeners to remember that these two perspectives aren't necessarily contradictory.
Okay, why not?
Well, again, Buffett's decision is likely based on the very specific goals and, the massive scale of Berkshire Hathaway. He's playing a different game than the average investor.
Right, he's not just trying to grow his wealth, he's trying to beat the market.
Exactly. And for most individual investors, simply investing in a low-cost, broadly diversified S&P 500 index fund can still be a great way to build wealth over the long term. Buffett himself has said this many times.
He has.
Wow.
Okay, and then you've got Tom Lee's prediction, which, love it or hate it, is at least based on some pretty big, macroeconomic trends that are happening right now.
Right. You've got the millennials entering their prime spending years. You've got the potential labor shortage, driving demand for AI. Those are real things.
Yeah, they are. And actually, the article ends by pointing out that as of right now, the S&P 500 is actually trading about 6% below its recent highs. So, from that perspective, buying into an S&P 500 index fund, like the Vanguard one that Buffett sold, might actually look like a pretty good deal at the moment.
So to recap everything we've talked about today, Warren Buffett selling his S&P 500 index funds doesn't necessarily mean you should too. It's more likely a reflection of his specific strategy with Berkshire Hathaway, not a lack of faith in the U.S. market as a whole.
And then on the other side of the spectrum, you have Tom Lee, who's predicting huge growth for the S&P 500 based on some pretty compelling economic trends that are in motion right now.
All very interesting stuff. And it really leads to, I think, an important question for all of you listening. Where do S&P 500 index funds fit into your personal investment strategy?
Right. And do you see those future growth drivers, like the rising spending power of millennials and the AI boom, as positive or negative forces? Or maybe something in between?
That's for you to decide. But hopefully, this deep dive has given you some food for thought as you navigate the exciting and sometimes confusing world of investing.